you're somebody that's looking at buying or building an investment portfolio in 2026, listen up. The game has changed completely. My name's Bo Arfi. I've been investing in Australia for over 12 years, and I bought my first investment property at 19 years old. I amassed a portfolio of over $30 million in property by the time I was 30, and I've now helped over 1,200 clients build up investment portfolios, anywhere from 1 to 2 properties, and we've got investors that have over 10 properties, and these properties are not $400,000 properties. These are people that have $10 million investment portfolios that started from a single move. Now it's true, with the recent budget changes, the game has changed completely. I'm gonna do something quite unique here today. I'm gonna share with you a strategy that I'm starting to implement and how I'm navigating my own portfolio, not to give general advice, but to go through real life actions of what I'll be doing to ensure that I'm able to come out on top and navigate through the recent changes that most Australians are gonna get caught up with. Before I show you what I'm doing, I need to show you why I've decided to build my portfolio the way that I have. Now let's go to the most specific thing that's hurting property prices at the moment. And it comes down to 2 key factors. The first thing here is that Australians were lied to. We were told in 2025 that interest rates were predicted to decrease and continue to do so. So we have the first thing here, which is rates, and essentially makes it either easy to get a return on your funds invested, or it makes it extremely difficult. This is something that hardly any Australians actually predicted would go up. Now, a lot of investors were jumping into the market in 2025 and prices were going up $10,000 to $12,000 every single week. I was in the ground speaking with real estate agents and negotiating for clients, and it was well and truly a seller's market in 2025. However, fast forward 6 months later, we have 3 interest rate hikes, we have a cash rate of 4.35%, and Aussies now become more scared. As time progresses, we have a budget, which was around 2 months ago, and that budget has had some of the most unprecedented changes that we've ever seen in Australian history. This change has left Australians not being able to trust the current systems. We've been told one thing and completely blindsided on the other side of the coin. Therefore, Australian property market has had a massive shakeup, and there's only going to be a few ways to win here in 2026. Now, when we're looking at this data, it's extremely important to remember that we are in fact looking at statistical data analysis. Although us Australians have been blindsided, lied to, and the trust is at an all-time low, let's keep looking at the data and see where things are going to go. The first thing here is the conflict in the Middle East. Is this set to continue, or is it cooling down? We've seen ceasefires, and personally, somebody who spent a lot of time in Dubai, I can tell you that the media headlines are far more dramatic than it actually is playing out. The second thing worth noting is that inflation is starting to come down, and CBA has refreshed their prediction to say that interest rates are going to be on hold until the end of the year, with the earliest cut not predicted until May 2027. Now, the interesting thing about buyers is a majority of investors have got one investment property, around 74% of investors to be exact. That means that most investors are considered unsophisticated. They are low-level investors that have 1 or 2 investment properties. In fact, investors that have between 1 and 2 investment properties make up around 94% of the population of people that are investing in assets inside Australia. This means that the investors who have over 4 investment properties is less than 1% of individual Australian investors. This tells you that you've got investors who are scared. However, a majority of these investors are unsophisticated and low net worth. And you also have a media machine that is pumping fear into the market for eyeballs. Myself, I had a $30 million portfolio by the time I was 30, and I liaise often with investors who have much bigger portfolios than me, 100 plus investment properties, and big investment asset vehicles, whether it's companies, they have commercial assets, or they do development. I speak to these people daily. The consensus of these guys is the same. I met with a developer last week and he's just bought the biggest site that he's ever purchased. I've met with a guy for coffee that has got over 96 properties and he has just bought another 10 assets in the last 2 months. Therefore, what is that telling you? It's saying that the smart money and the sophisticated investor is looking at this time as a buying opportunity and they're not listening to media headlines. Now in this section, I need you to pay attention because this is perhaps one of the most instrumental things as to why the property market will be booming over the next 24 months. It comes down to the most basic of things, supply versus demand. We've heard it, Australia is one of the countries that has the most percentage of migration for its population. We have 26, 27 million people, and every single year another 600,000 people are flooding into the country. What does that mean? Well, first of all, each of these people are going to need a place to live. Now, an interesting thing is that a lot of these people are used to living in conditions that are very different to ourselves. There's a saying there, and it says, tough times create hard men create good times create soft men create hard times. So what that means at the moment is that us as Australians, we have a coffee, relaxed, beer barbecue culture whereby we enjoy owning our white picket fence. However, we do not push and aspirate to have more because it looks bad to your fellow Aussie. However, the people that are coming into this country do not share the same sentiment. They're built on immigrant mentality. That means that these people are prepared to work hard, earn bigger incomes, and we've started to see it already. The Indian population is now out earning Australians. Additionally, these demographics of people coming into the country are happy to co-share the properties. So what this means is you might have 5, 6, 7 people in a 4-bedroom property. So they're pooling their money together as a team, and that means that they're able to pay a higher rental amount. Now, it's important to remember that all these people aren't going to qualify for a mortgage straight away. So remembering that if you can buy a property at today's price, wait for all this stuff to clear itself out and invest while you have negotiating power, this is the time that sophisticated investors are getting into the market. And it comes down to the key thing, supply. Now, based on the supply at the moment, we are building 173,000 homes per year. However, this is actually nowhere near enough the amount of properties that we need to be constructing. On average, we are going to need around 250,000 homes in order to house all the people that are coming in. So as per my previous point, people are going to need to co-share properties, rent out these assets together, and pool their money all together. So the point here is that what happens after you have record levels of net migration coming into this country, you have interest rates start to soften, and you have the aftermath of the budget start to fade away. It's been predicted that housing prices will again begin to soar around June to July 2027. And this is based on the core things here and there. The rates starting to decrease, the demand required, and the budget loopholes being enacted. We've seen in relation to the budget a record level of new businesses being created. As a note, these are not productive businesses. These are businesses that are aimed around loopholing the current government tax implementations and getting around some of those requirements. Buying properties inside a company has now been a very popular thing to ensure that investors are able to continue to get the benefits that they were previously able to get pre-budget night. The National Accord data has also indicated that we need around 1.2 million homes by 2029. On track at the moment, we are 940,000. So that means that we are around 260,000 homes off what is required in order to house all of these people coming into this country. On top of that, building approvals are much lower than where they need to be. Previously in 2015, we were approving around 12 dwellings per 1,000 people. Now it's 9 dwellings per 1,000 people. This means that homes are not getting built quick enough, and the data here is matching exactly what this picture is portraying. And this is exactly why I'm buying into this budget, not running away from it. The loopholes are still there. Negative gearing is grandfathered, and buying through a company is still an able way to conduct your inflows, your outflows, and instead of negative gearing or positive gearing your property, you're running it as if it was a business, either making a profit there or a loss there. Now, the next piece of the puzzle I want to look at here is the demand side of things. Now, Australia's population hit 27.7 million in 2025 and has recently just ticked over to 28 million people. This means that 420,000 Aussies joined the Australian population in 2025. Net overseas migration accounted for 73% of that, which was around 305,000 people. And our Australian birth rates, they're actually one of the lowest in the world, 1.48. That means that Australians are not having kids fast enough, and net overseas migration is what's actually popping up Australia's population growth. As of January 2026, there was just shy of 3 million temporary visa holders. And these people do not buy properties. They rent the properties first, and this sends the rents high because these people are going to need places to live. Now, the question that I get a lot is, what if migration slows? It's a very interesting question. Obviously, at the moment, we have 2.98 million people here on visas who are temporary residents. However, what if we stopped having this and we accepted 0% of people? Well, it's a great question. And even if the tap was turned off tomorrow, it will take 3 years to catch up to the demand that's now needed. Now, when it comes to vacancy rate, currently we're sitting on 1.2% vacancy. However, in a healthy market, this is typically around 2.5% to 3.5% vacancy. So when we compare the 1.2% vacancy rate at the moment with an average healthy market, which sits at 2.5% to 3%, you can see that obviously we have exceptional demand and price pressure on the properties that are on market at the moment. So despite the prices of property not increasing at the moment, the rental demand has never been higher and is predicted to continue to surge, and the rental requirement is only going to get higher and higher, meaning that rental price pressure is predicted to increase and even soar past levels that it already is sitting at the moment. Now, this is where we start to get specific. I mentioned in an earlier video that properties in Brighton, South Yarra were topping out and decreasing in their pricing, going down anywhere from around 9 to 12% in price growth. However, these properties were never good investments. Their rental yield sits at roughly around 2 to 2.5% rental yield. The interesting thing about Australia is outside this specific property, we actually have 8 markets in one. So with the 8 markets that we've got, you've got Perth that has increased at 13% in 2025, and that's on average. You've also got Brisbane, which appreciated at 12%, and you've got Adelaide that appreciated at 9% in 2025. Now, to remember that this is on average in these markets. These are not specific properties. So like I mentioned before with South Yarra and Brighton, which those market statistics don't look very good, you've got great properties mixed with very low performing properties. So what that means is investors that bought basically anything on average in WA would get 13% growth. But investors that were buying with strategy, smarts, at lower price points, higher rental yields, really capitalized on their upside, and that could be closer to around 20 to 25% growth on your money. Now, let's attract our attention to Melbourne and Sydney, which operate extremely differently. You've got in both of these markets more of a cooling approach. So in Q2 2026, Melbourne has depreciated around 2.3% on average, with Sydney doing something quite similar. Auction clearance rates are about as low as they've been in recent times, And this is the buyer's market that most people have been waiting for, but are now scared to take action. Now, both of these markets are quite different. You've got Sydney that's price correcting itself from a higher median house price. Now, the price difference between Melbourne and Sydney has actually never been further in recent times. At the moment, it's sitting at around 35 to 40% difference in pricing, which is extremely far apart. And the gap between both of these markets is predicted to close quite heavily over the next 2 to 3 years. This is the great thing about Australian property markets. Investors think that a market's tapped out. However, then you've got another market that's just starting their market cycle. You have 4 stages of the market cycle. You've got the peak, you've got a downturn, you've got a trough recession, and you've got an upside of the market. And every single market operates completely differently. So despite a lot of unsophisticated investors being scared, this is what the sophisticated investors understand. Now let's go through it, what you've all been waiting for, the playbook and how to run your property portfolio in 2026. At the moment, we can see that different markets are operating extremely differently. We've gone through the demand fundamentals, we've gone through supply, where there is simply not going to be enough properties to sustain the required growth of population that's coming into the country. Now, the media is telling a different story, and a story that it typically always tells. A story to get eyeballs and as many people on their media outlets as possible. The narrative goes something like this. Perth is booming, look at buying in Perth. Consider buying in Queensland. Queensland is a hot market. Meanwhile, you've got Melbourne in correction, down 2.3% in May. Melbourne, let's just bash it, and that is the weak market at the moment. However, the media is not an indicator of where prices are going, and that's where you have to look to the numbers, the statistics, and the fundamentals inside of property. Now, Perth was actually flat for the last decade before it had its recent surge. Sydney was a market that appreciated extremely quickly, but is now softening. Melbourne was a market that was catching up to Sydney, but then had some adversity with the recent government and so forth and slowed down. So now the gap between that Melbourne-Sydney sits at around 40%. So when I see Melbourne in correction, I see the media bashing it. I see the numbers looking very wearish. I see things not looking great. I don't think this is a horrible market, I'm never going to buy there. I simply look at the timeline of all the other markets, what's happened in the past, and from that point, I realize that the market is not finished, deflated, or completely dead. It is simply at its lower part of the cycle. It's in its recession, depreciation, or trough phase. Now, what comes after this phase is the upturn cycle. And then shortly after the upturn cycle, you'll see similar things to happen in Perth, Queensland, and Adelaide. You have peak cycles. Now, the thing with Victoria is it's been in this sort of lower period of recession trough for around 4 to 5 years. Now, traditionally, we thought the property clocks were 10 years. However, now the new property clock that many analysts are talking about is a 16-year property clock. So while a lot of the media and people talk about the negatives and how the market is finished, I see a market repricing for a potential increase in growth over the next 12 months. Melbourne has had a false start, but it's a start where many sophisticated investors that have big portfolios are all looking into and are all in agreement. Now let's get into what I'm actually buying and why. When you buy an asset, you're essentially buying 3 things. You're buying a land, you're buying a house content, and you're also buying in a location. So these are the things that you're getting. The thing that I like to note is when I'm purchasing, I like my house component to be fully tax deductible, because as we all know, the government loves to tax, and I love to have mechanisms that I'm able to get more of that tax back. If the government use their tax better, perhaps I will be more forthright in allowing them to have it. Perhaps not. But at the end of the day, they don't use it properly, and I want to keep more of my hard-earned money. Therefore, I utilize a system called depreciation, whereby I depreciate the whole value of the construction of the property over a 40-year period. So I'm 100% claiming the property construction cost on the house. This is something that you can only do with houses that are under 40 years old. And if a house is 10, 20, 30 years old, you have very little depreciation left because a lot of it is claimed at the start of construction. The next thing I'm getting is the land content. Now, at the end of the day, we all know the same thing. The land is what appreciates and the house itself depreciates. So if we can claim the house depreciating while the land inside that property goes up, then that's going to be a winning strategy. The house is going to be very important, however, because the house gives us rental income and it also allows us to hold the asset long term while the land appreciates. Another massive part of if your property is going to appreciate is the location itself. When you're buying in a particular location, it comes down to, again, supply versus demand factors. A lot of investment advisors simply go the blanket rule. Let's buy in blue chip and everything will be okay. However, that strategy is not a winning strategy for most Australians. The first reason is the median house price in Melbourne sits at around $1 million. This means that if you're going to get in an asset for $1 million, even at a 10% deposit, you're looking at $100,000 in deposit, $55,000 in stamp duty and other costs. You're also going to have a lender's mortgage insurance fee, which is probably going to sit around $27,000. So that means to get a property in Australia, even at a 90% loan to value ratio, you're spending almost $200,000 on your costs associated to acquire that asset. This is a strategy that is not really appealing to most investors and simply not possible. Therefore, I like to enact something a little bit differently. Firstly, I like to buy properties inside a trust or inside a company, and there's a few different reasons why. The first thing is tax distributions. And to be clear, I'm not a tax advisor, financial advisor, and this is just typically general advice. I'm not talking specifically to your situation. This is particularly on how I handle my own situation. Now, some of the things that you get out of buying properties inside trusts and companies is, first of all, limited liability and asset protection. So that's the first thing. The other thing you get is tax distributions. You can have the flexibility there in tax. You also have lending. So you have lending flexibility, and you're also able to add and remove people from the trust a lot easier than if you were to have it in your personal name. You would need to pay stamp duty if you wanted to move that asset. So flexibility, lending, tax, performance is just a good way to structure your companies and your property purchasing. However, this is completely dependent on your situation. And again, this is just on my personal portfolio. The other thing I do is I buy properties at today's price and I settle them at tomorrow's value. So what does that mean? In a market like this, the strategy can be very powerful. Buy at today's price, settle something that happens in 12 months. That means you're missing the higher rates of interest repayments. While the market is depressed, you are negotiating at this point in time where you're buying in a buyer's market. You're settling in a 12-month period and you're not having to carry any of the higher interest rates. This is something that's worked extremely well for me in the past and works very well, particularly in buyer's markets. Now, the benefits that you're going to get off buying an asset such as this is you're going to have property purchase is going to be a fair bit lower because we're looking at statistics. We're not just buying anything. So we'll buy something at 600,000. So let's say 60,000 for 10%. We're only going to pay stamp duty on the land component of the asset. So depending on that land component price, that might be looking at around $12,000, $13,000, $14,000 on the higher end. And we'll also have a lender's mortgage insurance that's probably going to sit anywhere from around $10,000 to $12,000. So what that means, we're going to have around an $82,000 to around an $84,000 deposit, rather than around $185,000, nearly $200,000 that is used to buy an average established property in a Melbourne market. This is something that's extremely important around what is the kind of properties that you're buying and how are you maximizing your three parts of the property purchase: the land component, the house side of things, and the location, which is essential for capital appreciation in the asset. Now, a lot of investment advisors and buyers advocates at the moment will tell you, jump in on apartments. Apartments are well priced, they're primed for growth, and they're the best asset class to get into. What people aren't telling you is the reason people are pushing apartments is because people can often not afford anything else. So for apartments, you're owning a very different kind of land content. If you've got a $700,000 purchase of an apartment, you're gonna have a much smaller land content. You'll have something like $650,000 of that 700 is in the build, and only around $50,000 is in the land content. And that's why apartments very rarely ever appreciate, because that land is going up at such a slow rate that there's virtually no reason for the property to appreciate. And let's take a deeper look at the numbers here. If you only own 7% of the land content, whereas if you're owning 30 or 40% of the land content and you're depreciating the house itself, your financial situation is going to be far better overall. Now, I see what some people say, where they say, well, is it better to own a land content in a established area like a St. Kilda or a Balaclava or a South Yarra? And the answer to that question is, well, even if the property grew at the same level, are you factoring in the whole pie? Now, when we go and we buy an asset, we're not only going for growth. Growth is predominantly, let's say, the most important, but we're getting a range of other things associated to that as well. And this is what I refer to as the 4 types of savings. The first type of saving that we're going to get is we've got cash flow. Cash flow is very important. It allows us to continue to buy and allows us to service the debt on the property. You've also got tax minimization on the asset. You've got debt reduction if the property is paying for itself or if it's not. And finally, you've got the growth of the property. Far too many people only look at growth and they don't look at how the asset affects their overall situation. What is their opportunity cost from the cash flow? Is saving an extra 14 to 15K per year beneficial for their situation rather than saving next to nothing in peanuts? And is the property paying for itself on principal and interest, or is it just negatively geared on interest only? What is the deeper part of the property acquisition? You also have to consider what it costs to get into the property market too. As I mentioned before, $1 million worth of asset costs you around $185,000 to get in. So if you're looking at buying a $900,000 property in Toorak, for instance, it's an apartment or a South Yarra apartment or a St. Kilda apartment, you have to know that you're going to be forecasting $140,000, $150 plus $1,000 minimum, as opposed to $80,000 that you're going to require to get into this house with land content asset, as opposed to a low land content apartment. Now, it's important to remember that land content alone is not everything. At the end of the day, you could have a land in a suburban area that has got really no growth indicators, and just because you've got the land content, it doesn't mean your property is going to appreciate. Therefore, you want to maximize your land content in a growth market that has significant drivers and infrastructure in place. A market that you perhaps have less land content in, however, it's in a market that has a new school, shopping center, hospital, train line, freeways, all of this sorts of infrastructure coming through is going to do far better than a larger piece of land content in a suburban area with lacking growth indicators and government infrastructure. So the formula here is land content plus high growth drivers equals property price appreciation. So let's break it down. It's important to remember that you're not just buying cheap for the sake of getting into the market. You're buying something that's in a good location, that has good depreciation factors, so that as your income rises, you're not having to constantly pay tax to the government who's not even using it properly. And the other thing is you need to have good land content, and location. All right, this is it, the playbook. So far, I've shown you supply, demand, interest rates. I've discussed holding structures. We've talked about how to select a property when it's in comparison to a blue chip apartment versus a house with land content, and basically what does the situation look like. However, here's how we're going to apply it in real-time practice, so you don't want to miss this. Now, something extremely important now is how will you hold your property? Three main ways. You've got your personal name, you have company, and you have a trust structure. So in these three types of holdings, inside the individual personal name, you've got the simple structure. You've got the negative gearing on new builds, you've got the CGT exemption, and it is the most simple and straightforward structure that most investors will typically start with. The next thing I'll put here is a company. Now, this company is usually got around 25 to 30% in corporate tax rate. It has asset protection. However, there is no CGT discount. The third is a trust structure. You've got income distribution, very flexible. You've got asset protection, which is also very favorable. However, your losses, gains, are locked inside the trust. So they are ring-fenced inside the trust. Now, as we've seen in recent times, the government has directly attacked trusts, and it's a spot where we didn't think that it was going to be affected. However, the government is fully attacking the ownership structure inside a trust. Now, at the moment, I want to talk about company structure, which at this stage seems to be the most favorite approach for property investors. Now, for most investors that are just starting out, a company is not necessarily the best place to start. Companies are typically better for development or more complex portfolios, or people running investment property management companies for their own assets inside of the company. This is where the real winners of company structures are going to be. Now, in my playbook, structure is one of the most important things that I do. It's more important, and it's the first thing that I start with, because the structure depends on how my assets are protected, how much tax I pay, how I'm able to duplicate, and what the long-term play is of that particular asset. So I start with the structure, and then I begin on the asset purchasing journey. Now, location is extremely important when buying an asset. However, we won't touch in on all of the leading growth indicators on this video, as I'm going to need a separate video to go through all of these leading indicators. However, location is going to be extremely important and is one of the three factors associated with a successful and well-priced asset purchase, and also something that is going to depreciate and be a well-rounded investment for you, allowing for you to take equity out and continue duplicating. Therefore, three extremely important things which we've discussed today: structure, asset, and location of the property. These things are going to determine whether the asset's going to flunk or fly. And this is something that I personally map out with every single client at Maple Group before they buy, to make sure that we're having a successful outcome, we have repeat business, and we have constant duplication. And there you have it. The playbook that I've mentioned today is the same one that I'm implementing for Maple clients in 2026. Structure first, houses only, location being extremely important, growth cycles, add value potential, as well as not letting the media and emotions dictate your financial decision. There you have it. Some of the tools that I use to ensure that my own and my clients' portfolios are successful, strong, streamlined, and overall powerful for continued duplication. If you're looking at building a large-scale investment portfolio, even if you haven't bought your first investment property yet, give us a call, reach out, and I'll be more than happy to help you personally chat and build up a long-standing portfolio in Australia, because it is getting harder and finding the right property is now more complex than ever. So I believe it's always important to work with people that have done what you want to achieve. So for everybody watching this video who made it to the end, we're happy to give a 45-minute free strategy session, which is going to go through your goals, where you want to be, and how you're going to get there. Click on the link below, and I look forward to speaking with you guys soon. Also, guys, hit the like and subscribe button, and I'll be sure to bring more of this information to market.